Gold has long been regarded as one of the most valuable and stable assets in the history of human civilization. From ancient times to the present day, gold has served as a reliable store of value, a symbol of wealth, and a hedge against economic uncertainty. Its significance is deeply rooted in its unique properties and its enduring appeal as a financial asset. As we navigate the economic challenges of 2024, understanding the role of gold in a diversified investment portfolio is more crucial than ever. To appreciate the importance of gold, let's take a journey back in time to the year 1848. Imagine standing at Sutter's Mill in California, where James W. Marshall has just discovered gold. This single event triggered the California gold rush, drawing thousands of prospectors from around the world, all hoping to strike it rich. The feverish pursuit of gold transformed economies and shaped the destiny of the American West. But gold's allure and value were recognized long before the gold rush. The history of gold stretches back thousands of years, woven into the fabric of human civilization. Ancient Egyptians revered gold as a symbol of eternal life and used it to create elaborate jewelry and burial artifacts. Gold was so highly valued that it was often buried with pharaohs and nobility to accompany them in the afterlife. The Greeks and Romans also placed immense value on gold, using it to mint coins that facilitated trade across vast empires. Gold's ability to maintain its value through ages of change and turmoil solidified its status as a reliable asset. In modern times, gold continues to play a pivotal role in global finance. Its importance becomes particularly evident during periods of economic crisis. Consider the Great Depression of the 1930s. As stock markets crashed and banks failed, people turned to gold to protect their savings. Gold prices surged, providing a safe haven for investors amidst the financial chaos. Similarly, during World War II, gold financed massive war efforts and helped stabilize economies ravaged by conflict. Fast forward to the 2008 financial crisis, and gold once again demonstrated its resilience. As housing markets collapsed and financial institutions crumbled, gold prices soared. Investors flocked to gold, seeking safety in a time of unprecedented uncertainty. These historical events are not mere anecdotes. They underscore gold's ability to preserve wealth and provide stability during periods of economic stress. As we navigate 2024, the global economy faces a new set of challenges. Inflation rates are climbing, geopolitical tensions are escalating, and financial markets are increasingly volatile. These factors create a perfect storm of uncertainty, prompting investors to seek out safe haven assets. Gold, with its unique qualities, stands out as a robust option. But what exactly makes gold such an attractive asset during turbulent times? First, it's a tangible asset. Unlike stocks or bonds, which are essentially pieces of paper or digital entries, gold is something you can hold. This physical presence provides a sense of security that digital assets cannot match. Gold is not subject to the same risks as other financial instruments. It doesn't depend on the solvency of a company or the stability of a government. Its value is intrinsic, rooted in its rarity and universal appeal. Second, gold is universally recognized and valued. No matter where you are in the world, gold is accepted as a form of currency and a store of value. This global recognition makes gold an excellent diversifier in any investment portfolio. It's not tied to any specific country's economy or currency, which means it can serve as a hedge against currency devaluation and geopolitical risks. Moreover, gold often has an inverse relationship with other asset classes. During economic downturns, stocks typically suffer significant losses due to decreased corporate earnings and investor panic. Bonds, while generally considered safe, can lose value in times of rising inflation. Cryptocurrencies, despite their growing popularity, are extremely volatile and not yet universally accepted as a store of value. Gold, on the other hand, tends to hold its value or even appreciate when other assets decline, providing a counterbalance and reducing overall portfolio risk. Consider the story of Sarah, a savvy investor in her mid-40s. Sarah had a well-diversified portfolio with stocks, bonds, real estate, and a small allocation to gold. In early 2023, as inflation began to rise and market volatility increased, Sarah noticed that her gold investments were performing well even as her stocks took a hit. Her decision to include gold in her portfolio wasn't random. She understood that gold's negative correlation with stocks and bonds could help stabilize her overall returns. By allocating just 10% of her portfolio to gold, Sarah was able to reduce her overall risk and improve her portfolio's performance during turbulent times. This strategic allocation to gold is not unique to Sarah. Financial advisors often recommend including gold in investment strategies to enhance diversification and mitigate risk. A common guideline is to allocate 5 to 10% of your portfolio to gold. This allocation provides a cushion against market downturns without sacrificing too much growth potential from other asset classes. Each investor's situation is unique, so it's essential to tailor your strategy to your individual needs and goals. Studies have shown that portfolios with a small allocation to gold tend to perform better during periods of economic stress compared to those without gold. This is because gold's value often rises when other assets decline, providing a buffer against losses. Using financial planning tools and working with a financial advisor can help you determine the optimal gold allocation for your specific situation. Factors to consider include your risk tolerance, investment horizon, and financial goals. To gain deeper insights into gold's future outlook, we spoke with several financial experts and market analysts. Their perspectives shed light on the strategic importance of gold in the current economic climate. One expert emphasized, given the current economic uncertainties, gold is likely to remain a strong performer. With central banks printing money at unprecedented rates, inflation concerns are driving more investors towards gold as a hedge. Another analyst added, while we may see short-term fluctuations in gold prices, the long-term outlook is bullish. Gold's intrinsic value and limited supply make it a reliable store of value, especially in times of economic instability. A financial advisor noted, investors should consider gold as a strategic component of their portfolio. Its ability to preserve wealth and provide stability during market downturns is unparalleled. As geopolitical tensions and economic uncertainties persist, gold will continue to be a crucial asset. These expert opinions reinforce the strategic role of gold in investment portfolios. But beyond expert advice, real-life success stories also illustrate gold's impact. John, a retiree who invested in gold during the 2008 financial crisis, found his retirement savings protected from significant losses as gold prices surged while the stock market plummeted. This experience taught John the value of diversification and the protective power of gold. Emily, a young professional, started investing in gold as part of her long-term financial strategy. Despite market volatility, Emily's gold investments have provided steady returns and peace of mind, knowing that a portion of her portfolio is insulated from economic shocks. These stories highlight the practical benefits of including gold in your investment portfolio. But how do you actually invest in gold? There are several ways to invest in gold, each with its own set of advantages and considerations. One of the most traditional methods is purchasing physical gold in the form of coins or bars. This approach allows you to own the metal directly, providing a tangible sense of security. However, it also comes with the need for secure storage and insurance. Another popular option is investing in gold ETFs, or exchange-traded funds. These funds track the price of gold and can be bought and sold just like stocks. They offer the convenience of liquidity and don't require physical storage, making them a practical choice for many investors. Investing in gold mining stocks is another way to gain exposure to gold. These stocks represent shares in companies that mine and produce gold. While they can offer substantial returns, they also come with higher risk due to factors like mining operations and market fluctuations. Finally, there are gold mutual funds, which pool investors' money to invest in a diversified portfolio of gold-related assets. This option provides professional management and diversification, but typically comes with management fees. Choosing the right method depends on your investment goals, risk tolerance, and preferences. Some investors prefer the physical presence of gold, while others appreciate the ease and liquidity of ETFs. Mining stocks and mutual funds offer additional diversification but require more research and risk management. To truly appreciate the value of gold, it's helpful to compare its performance against other asset classes. During economic downturns, stocks often suffer significant losses due to decreased corporate earnings and investor panic. Bonds, while generally considered safe, can lose value in times of rising inflation. Cryptocurrencies, despite their growing popularity, are extremely volatile and not yet universally accepted as a store of value. Gold, on the other hand, tends to hold its value or even appreciate, providing a counterbalance and reducing overall portfolio risk. Gold's resilience during economic downturns stems from its unique characteristics. First, it's a tangible asset. Unlike stocks or bonds, which are essentially pieces of paper or digital entries, gold is something you can hold. This physical presence provides a sense of security that other investments can't match. Second, gold is universally recognized and valued. No matter where you are in the world, gold is accepted as a form of currency and a store of value. This global recognition makes gold an excellent diversifier in any investment portfolio. Furthermore, gold is not tied to any specific country's economy or currency. This independence makes it an effective hedge against currency devaluation and geopolitical risks. When other assets like stocks or bonds are performing poorly, gold often holds its value or even appreciates, providing a counterbalance. Consider again the story of Sarah, who strategically included gold in her portfolio. Her experience underscores the practical benefits of diversification. Financial advisors often recommend a similar approach, suggesting an allocation of 5 to 10% of your portfolio to gold. This allocation provides a cushion against market downturns without sacrificing too much growth potential from other asset classes. Studies have shown that portfolios with a small allocation to gold tend to perform better during periods of economic stress compared to those without gold. This is because gold's value often rises when other assets decline, providing a buffer against losses. Using financial planning tools and working with a financial advisor can help you determine the optimal gold allocation for your specific situation. Factors to consider include your risk tolerance, investment horizon, and financial goals. In addition to its role as a safe haven, gold also offers potential for growth. The demand for gold comes not only from investors, but also from industries such as jewelry, technology, and central banks. This diverse demand can drive gold prices higher, offering capital appreciation opportunities for investors. One of the key drivers of gold prices is jewelry demand. Countries like India and China have a deep cultural affinity for gold jewelry, which is often given as gifts during weddings and festivals. This cultural demand provides a steady base of support for gold prices. In the technology sector, gold is used in various applications, including electronics and medical devices. Its excellent conductivity and resistance to corrosion make it an ideal material for high-tech industries. As technology continues to advance, the demand for gold in this sector is likely to grow. Central banks also play a significant role in the gold market. Many central banks hold gold as part of their foreign exchange reserves, viewing it as a hedge against currency devaluation and economic instability. In recent years, several central banks have increased their gold reserves, further supporting gold prices. Another important aspect to consider is the supply side of the gold market. Gold mining is a complex and capital-intensive process. The cost of extracting gold from the earth has been rising due to factors such as labor costs, environmental regulations, and declining ore grades. This can limit the supply of new gold, providing additional support for prices. Gold mining stocks offer a way to gain exposure to the gold market while also benefiting from the potential for operational efficiencies and exploration success. Companies that can increase their production or discover new gold deposits can see significant stock price appreciation. However, investing in mining stocks also comes with risks, such as operational challenges and geopolitical factors affecting mining operations. For investors seeking a more hands-off approach, gold mutual funds and ETFs provide diversification and professional management. These funds invest in a variety of gold-related assets, including physical gold, mining stocks, and gold futures. They offer a convenient way to gain exposure to the gold market without the need for individual stock selection or physical storage. As we look to the future, it's clear that gold will continue to play a vital role in investment portfolios. Its unique properties as a tangible asset, a store of value, and a hedge against economic uncertainty make it an invaluable tool for preserving wealth and providing stability. In conclusion, gold's role in a diversified investment portfolio amidst economic uncertainty cannot be overstated. Its unique characteristics make it an invaluable asset for preserving wealth and providing stability. By understanding and strategically including gold in your portfolio, you can navigate the turbulent economic landscape of 2024 and beyond with confidence. Gold's enduring appeal and proven track record make it a timeless choice for investors seeking to safeguard their financial future.